Bloomberg Audio Studios. Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Tough day to be a retailer here. Lululemon, Nike, some disappointing numbers. Stocks taking a hit here today. Let's get the analysis, and we can do that with Poonam Goyal. She's a senior research analyst covering all things on the retail space for Bloomberg Intelligence, joining us from Princeton via Zoom here. Poonam, let's start with Nike here. Stock off about 8% here. I guess a tough first half outlook here, and Bloomberg reporting is talking about some competition from upstarts On and Hoka. Talk to us about Nike. What did you take away today?
Sure. The outlook is definitely much weaker than we would have anticipated, but I think they're positioning themselves for longer term growth. So they talked a lot about innovation in the Air franchise that they have and really expanding that to other sneaker silhouettes. And we think that will position them for longer term growth. But definitely there is a softer start to the year. The first half of fiscal 2025 will be challenging. The light at the end of the tunnel is that 2H25 will be better and we'll end the year on a positive note based on their expectations. And I think the real key here is to focus on the product innovation that they're going to bring forward over the coming 12 to 18 months to really see if Nike can continue its journey to maintain its brand lead. It is a $50 billion company, Paul. So when, folks talk about On and Hoka, when you look at the size of the two versus what Nike has, they're still very, very, very small in comparison.
Poonam, I look at Nike and one of the other stocks you're watching, Lululemon today, really the big decliners in the S&P 500. And I wonder if there's any sort of broader takeaway, sort of a macro takeaway to be had here about the health of the consumer, or is this very much, sort of just brand specific issues for these two, or is there sort of a return to office story still at play with these two brands at all?
I think it's a combination of a multitude of things. So I think the first is that, yes, there is a consumer pullback that's happening. We heard that from Adidas and Puma too with their softer guidance. So that's not necessarily a big surprise that the consumer is pulling back on discretionary spend. And we saw that with better numbers at Walmart and Amazon, where you kind of push for value a little more. On the other hand, you do have to worry about the product, because the one thing that Lululemon said that was interesting is, yes, traffic was down at stores, but conversion was also weaker. And that means that there's something happening with the product. And they did talk about the need to really up their product cycle and replenish to have inventory in stock, because they did see some weakness from that. So I think it's a culmination of a pullback in the consumer, the product, and also that the athleisure market, I think, is still strong. I think there's still potential there globally. I do think coming off from the pandemic that you will have some normalization of a wardrobe where it's going to be more balanced today than it was, let's say, 2 or 3 years ago, where it was probably 80% athleisure, 20% work life. Today, it's probably leaning back to 50-50.
So you'll be relieved to know that I am not a Lululemon customer, but talk to me about fashion. Is it, I mean, it's all a similar type of fabric and fit. So is it just colors and patterns and things like that? How do you change that up? Because I know getting the fashion right is so important, for the companies that you follow.
Actually, Paul, for Lululemon, yes, it's about getting the color and fashion right, but it's also about the fit and the fabric. Their Align pants, which are their best sellers, the biggest sell on that is the way that they fit you. They make you look good. And every woman wants to look good. So that's the differentiator between a Lululemon yoga pant and, let's say, a Nike yoga pant. There is a difference in the quality of the pant that you're wearing and the fit that it has.
Don't kid anyone. Paul's wearing yoga pants right now.
Yeah.
Actually, they're dress pants. They have some pretty good. Lululemon has
Do
nice men's dress pants. Yeah, I've got a couple pairs of those.
Look at that.
Yeah. Put them back to Nike. One headline I saw that kind of shocked me is that Nike was able to get the sponsorship of the German national soccer team, taking it away from Adidas.
You can't do that.
Which is pretty. Yeah, it's pretty. Shocking for a soccer fan. I mean, you grow up watching Adidas on the shirts of basically every team. But how big of a deal is that as far as that global soccer market for Nike and sort of this rivalry with Adidas and that sponsorship?
Yeah, look, I think it's a big win for Nike because Adidas is a German brand and it has held that sponsorship for, I believe, over 75 years. So to lose that to Nike is a big deal. And it puts Nike on a stronger foothold across the globe in the field of soccer. So we do think that this is a big win for them, but make no mistake, they paid a premium for this. So it wasn't something that they took away at a steal. They definitely paid up for it.
So I did just recently watched the movie The Jordan, and kind of story about how he got and the relationship with Nike and kind of how that all plays out. But now the dollars are just so much bigger. So, so Poonam, as you look across the Poonams, I mean the Nikes of the world and the Adidas and the Pumas and things like that, is that still a huge part of their marketing strategy? Is to align themselves with teams, with individual players? Is that still as big as it always has been?
It is as big as it's always been, but now it's harder to come up in that playing field with some of the major players unless you have deep pockets. So really only Nike and Adidas can afford to spend the money that they're spending to win these leagues and their players. These smaller companies like Puma, you mentioned, and Under Armour, they're making a bet on rookies. So you saw the success that Under Armour has had with the Curry franchise, and that bet was made a long time ago. You're not going to see these smaller brands chase after the established bigger players and the bigger teams because they don't have the pockets for it. And that's where Adidas and Nike win, and that's what makes them really keep their number one and number two positions in the global sportswear industry.
Well, Poonam, how about all the other sort of also plays out there? Is there any sign of the dominance of these two companies being threatened at all? We see a lot of these sort of Instagram brands, and Amazon brands. Is that a threat to these major players in this industry yet?
I'd say that the industry is broadening, right? So in the sportswear world, traditionally it was all about performance and being on the field playing. Today, it's about walking the roads and really wearing it in your day-to-day life. So competition is growing. And there is also competition growing on the performance side with the Hokas and the Ons. They're very popular shoes, and they've actually taken share in the running category. So I do think that both Adidas and Nike have to step up their game to really add more innovation, but they're still small. So I don't think, Nike is at risk of losing its number one position just yet. They win by a wide margin, but it's something to keep an eye on over time.
Poonam, let's step away from these two stories here and look at your overall coverage. You follow a wide range of retail. You've done that for decades, one of the top retail analysts on the street. What are some of the stories that you think are interesting now? What are you talking to your clients about these days?
I think we're talking about the consumer a lot, right? The consumer's clearly pulled back, and what does that mean in an election year? So we think the consumer is going to remain soft this year, but we think the consumer is stretching their dollars. So they're looking for value. So value will remain top of mind. But that said, they're traveling. So it's not that we're going into a recession by any means. They're not going to fall off a cliff, but they're spending money where they feel that they're getting the most bang for it. And we think there'll be a trend that we continue to see as this year unfolds.
I mean, is that a Walmart/Target story, or does that steer me to maybe the dollar stores?
I'd say, the winners here would probably be, and what we've seen in the past in the fourth quarter is the Walmarts, right? The Walmarts where you find value and you find a broad range of assortment, and where you have a customer that's more broad-based versus the customer of a Dollar General, where they are more lower income and they are too pressured. Walmart attracts a broader market and they offer the value that you get.
All right, Poonam, excellent stuff. As always, Poonam Goyal, senior analyst. She covers all the retail space for Bloomberg Intelligence. We were talking about Nike and Lululemon. Some disappointing numbers. Nike off about 8%, but as Michael was reporting earlier, Lululemon off about almost 18% here. So a big pullback here for those two retail names. And the question I think a lot of people, Mike, a lot of investors, when they look at the earnings from a Nike or Lululemon, what does it tell you about the consumer?
And it was interesting to hear Poonam talk about that, how it's not just execution, it's not just market share story here. It does seem like on top of everything else, there is a little bit of some either spending pullback or at least bargain hunting.
Yeah, and then you compare
consumers.
that to what you hear from like the cruise lines. They're still packing them.
Yeah, fair point.
So people are spending money. They're just spending a little bit differently than maybe pre-pandemic. I don't know.
Yeah.
Still on that experiential track, I guess, if you will. Because, again, you think about some of these, the theme park operators, the cruise directors, the hotels, the casinos, still seeing really good traffic.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get right to it. Lee Klaskow in the house, darkening the door. Whenever we see him walking around, we just grab him, because it's a long walk for me down to Princeton. So anyway, Lee, you've been covering FedEx forever. You've been covering all these logistic companies, the rails, the trucks, all the shippers. You know this stuff end to end. FedEx seems to me to be a core story within that global logistics. What went wrong, and then what have they been doing to fix it?
Yeah, so FedEx is a great story, and it's an improving story. And the reality is that over the years, it got too big for itself, and it got too fat. And there was a lot of hesitation to combine its network. So as an air network and a ground network, its ground network is mostly independent contractors, and its air network are employees. So it's not easy to integrate those networks. And a lot of analysts have always said we should integrate them, and management would say, you guys don't understand our business, we can't do that. Well, fast forward, they're doing it, and that's their tricolor strategy, where they're which is redesigning their air freight network, and they're also combining their express and ground and services business into one segment, if you will. It's pretty much everything, but they're less than truckload business. So they're doing a lot on.
This sounds like a good old fashioned. We got to restructure our business.
Yeah, and they're gonna emerge as a lot more efficient. They're gonna emerge as a lot more profitable, and that's the hope. Their express network has really poor margins. I mean, their margins were 2.3% in the quarter, and that was real good outperformance in what the street was expecting by over 110 basis points.
PGO function.
Yeah,
I'm just seeing that. Very good. Okay, the numbers are good.
Yeah.
Okay. All right. So what's next steps for them?
So, as you heard earlier, they announced a $5 billion stock buyback plan. I think that gives people confidence in management's ability to execute. Execution risk is really the number one concern I think the street might have. As you probably saw in the Bloomberg terminal today, everyone's raising their price targets and their estimates for fiscal 2025 and beyond. And that's really driven by, they're cutting about $1.8 billion in costs this fiscal year, and they're going to do about $2.2 billion next. And if you think about it, $1.8 billion is about $5.75 per share, and this is a stock that was generating $15 in EPS. So these are sizable increases in the overall profitability of the company. Management, they've stumbled here and there, but it really seems this last quarter that they're executing and they're focused, and they're building confidence. And sentiment is so important when it comes to FedEx, which has struggled in the past.
Lee, when you talk about saving, cutting costs by that degree, I mean, I assume that's mostly headcount to some degree. Where are they cutting jobs? Is it just redundancy between the separate units now that they're combined? A company like FedEx, it seems like it'd be tough to cut those union jobs, the drivers and that sort of thing. Is it middle managers that are getting the pay slips?
FedEx is a non-union shop, except for its pilots. Its pilots are union.
Their drivers are non-union. Okay.
The drivers, most of their drivers that come to your house are actually, they don't work for FedEx.
Gotcha.
They're independent
UPS
contractors.
drivers are union, right?
Correct.
Okay,
they're the Teamsters. So where are they cutting heads? Well, they're not really cutting that deep. What they're doing is they're getting rid of middle management. Like I said in the beginning, they've gotten a little fat, so they're getting rid of some middle management. A lot of that is through attrition, some natural attrition. It's not like what was the guy's name, Jack the Chainsaw guy coming in with destroying companies. I think it's going to be more of a gradual shift. And as they combine networks, they're going to figure out where the redundancies lie, and they're going to benefit from reducing those redundancies. And that's through their Drive initiative and their Network 2.0 initiatives that they have out there.
Has FedEx or UPS or any of the other global shippers, have they talked about problems getting planes, because Boeing's in the news every day. Unfortunately, we have to talk to George Ferguson every day because Boeing's always in the news. Has any of these companies ever said, we're not getting the planes we need for our fleet?
No, that's not a problem, because what they're doing is they're actually, FedEx is trying to downsize its fleet, because with this whole redesign of their air fleet, they're going to need probably less planes over time. And those planes that they're going to be operating are going to be operating much more efficient. They're going to have a lot more density. When you talk about freight and transportation networks, it's all about density, how much stuff you have in whether your truck or your train or your plane. And so that's going to be key for them to drive those margins higher in the express business.
You know, Lee, I've read that there's a lot of sort of R&D looking at the automation of package delivery. You know, or is there a chance in our lifetime that we'll see, you know, sort of driverless vehicles dropping our packages off, that sort of thing?
I'm not a whole huge bull on like autonomous trucks or delivery.
Why not?
But you know what they will be doing is they will be leveraging technology and AI to make sure a package gets into the right network and gets and it has that delivery promise that they have, whether it's overnight or deferred. You know, what they're really going to be doing is using technology to make sure that package gets into the right network.
Yeah, but you don't think the technology's going to be there to actually have a driverless type of delivery?
Not anytime soon. Maybe, you know, little niche markets they might have, and kind of just highlighting, you know, those little robots that
drones
that go around towns, and you see pictures of people beating up the poor little robots,
right,
knocking them over.
Exactly. So during the pandemic, Lee became, for better or worse, kind of our supply chain guru, because it covers all the companies, like the shipping companies that get the stuff to our shore, then the rails that take them into, like, you know, middle America, and then the trucking companies that deliver them to everywhere, and all that kind of stuff. So let's start with the rails here. I'm looking at the trailing 12 months. These stocks have done pretty well. I mean, you know, they're all up mid-30s%. Norfolk Southern, CSX, Union Pacific. Pretty good performance. What's the story for the rails these days?
Yeah, there's really not a homogeneous story with the rails.
Okay.
Interestingly enough, it's really company specific. Norfolk Southern, it's all about activist investors. You know, they're dealing with Ancora, which is trying to kick out management and put their own precision scheduling railroad management team in. Norfolk Southern has come back and said, we have our own guy that we want to put in from PSR. Some investors might be, well, it's a little too late. You should have done that a couple of years ago. So no matter who wins the battle, Norfolk Southern will emerge as a much more profitable company. And then Union Pacific, another story. They had a change in CEO. Jim Vena is a PSR, precision scheduling railroading guy. And for those out there, PSR is really just Six Sigma for the railroads. It's just operating really efficient networks, sweating assets, that sort of stuff. And he's coming in, and he's got, you know, his own vision of how that railroad should operate. And then the littlest one, even after a merger, Canadian Pacific, Kansas City, you know, they have their own growth story, because now they are the only railroad that goes from Canada into Mexico.
Yeah, that's a great story.
And so they are the only railroad that is probably going to grow earnings in this last quarter, the first quarter.
How about the truckers? I'm looking, and I put up JBHT. That's the ticker I always remember. And you hit the BQ function. It gives you the relative valuation relative to its peers. Truckers not doing as well. I'm looking at JBHT over the trailing 12 months. It's up 18%, but some of the others are down. What's the word on the trucking biz?
So trucking has been not great, and that's really just too much supply out there, and that excess supply is killing the truckload spot market, which is down, you know, mid-teens from last year. And that is weighing on contractual rates, and that's where most publicly traded trucking companies play. Some pure play truckload carriers are like Heartland Express. Knight Swift is a major truckload carrier, so is Werner. But, you know, a lot of them don't play in that really volatile spot market business, but it does impact their overall earnings ability. And a lot of them have been diversifying into less volatile businesses. Werner, for instance, is a big dedicated carrier, so it's more like they'll go to Walmart and say, we're going to haul stuff for you between Chicago and New York. We'll do 10 trucks a week. Or between DCs and retail stores, and they sometimes even load the shelves at CVS, some dedicated services. So that's one area. Freight brokerage, which is obviously non-asset and higher ROIC, which is attractive to a lot of them. And when you started with JB Hunt, their trucking company is their trucking company business is probably one of their smallest segments. It's really an intermodal provider, and a brokerage provider, and a dedicated provider.
Lee, the other getting back to FedEx, the other big headline was this $5 billion share buyback.
Yep.
Is that what you think has investors excited, or is it more the actual execution and the performance?
I think it's actually both. I think they wouldn't have said $5 billion if management isn't confident on their ability to execute. Like I said, execution risk is high because things happen. A lot of transportation companies like to say their businesses are outside sports. You have weather to deal with, and that was something that was really interesting during the quarter. FedEx, their express business and their Memphis hub, which is their biggest hub, dealt with a lot of bad weather, and they were able to, it really didn't impact it that much. And a lot of people were expecting low margins on that express business of around 1% because of the weather. And again, they exceed that expectation by around 110 basis points.
All right, so now step back. We'll put it all together. Supply chain. Is it fixed? Are we back to new normal? Are we back to a new normal? If I order something, or more importantly, a retailer orders something, they expect to get it by a certain date. Are they going to get it by that date?
Yeah, and like the biggest risks looking forward is that the East Coast ports are negotiating with their labor. That's in September that contract comes due. And so what you could see is some work stoppages, God forbid a strike. And that's putting a lot of retailers and shippers on notice. They might be moving freight to the West Coast. They might start ordering for peak season a little earlier. So peak could be a little lumpier, if you will, start a little earlier. So I think that's the biggest risk, I guess, down the road. Obviously, the geopolitical stuff we can never guess when that's going to hit the fan.
During the pandemic, we had Gene Soroka, who runs the Port of L.A. He was on our show a lot. He was really helpful in understanding kind of where these ships are from China. Where are they going? How long do they have to sit out there in port? And during their work issues, I guess I'm not sure if they actually had a strike, I can't recall, but they lost some business to the East Coast ports.
Right.
And he's been coming back here and kind of trying to get that business back for LA. So it is competitive between ports, but now I can't even get through the Panama Canal easily, right? Because I got a water problem there.
We got low water.
Go fix that. You got to get you down there to fix that. I mean, what do you do with the low water in the Panama Canal?
Start digging, I guess.
Rain dance, maybe.
But that's a real issue, right?
Yes, it is. And what happens is that the ships that normally traverse across the Panama Canal can do so, but they can do so with less freight in it, so it weighs it down because the canal is more shallow. So there are ships going through, but those ships are carrying less freight, and so therefore the cost per ton of whatever you're shipping increases. The Suez Canal is probably more of an issue of what's going on there with the Houthis.
Is anything going through there these days?
If you're a Chinese ship or an Iranian ship,
really?
Or a Russian
ship,
they'll
let you go through?
Oh, they'll let you go through.
Yeah, they came out and said yesterday they won't touch them.
Yeah, and obviously the Houthis are aligned with the Iranians, and the Iranians are partners with the Chinese and the Russians. So they're able to traverse through there.
See, I'm telling you, logistics, supply chain, it's fascinating to me. And you know what? I totally, during business school when we had that class, I skipped it probably half the time to go across the street and play the Duke golf course.
It was one of those things that no one really worried about until it was crisis time.
Right.
And I mean, Lee obviously worried about it, but Lee, how do you think sort of, now that we're on the other side of the pandemic, it was such a crisis with logistics and supply chains.
Right.
Is there a legacy, no company wants to sort of fight the last war, but are there sort of permanent changes that you can look at and say these companies have been able to eke out some efficiencies or something about their business that they learned a lesson from these supply chain issues that they'll carry forward?
Right. Well, the changes that we're seeing is an increase in nearshoring and de-risking, and the reality is that this is not going to happen overnight. It's going to be like watching grass grow. It takes a long time to put a new facility up in Mexico or even the United States for that matter. So I think you're going to see more and more of that, and that's a net positive for the domestic transportation companies. It's a net positive for, like I mentioned earlier, Canadian Pacific, who has operations in Mexico, Werner, who does a lot of cross-border business across Mexico. So these are companies that will definitely benefit from that movement, and it's a long-term, slow, secular growth story for transportation.
All right, Lee, great stuff as always. Always appreciate getting your time. Lee Klaskow, he's the Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Story out of Tesla here. Tesla trims car output in China as EV sales growth slows. And that is probably the number one issue, I would think, for this stock, even for the industry a little bit, is kind of what is the ultimate demand for electric vehicles here in the near term, but then even also going forward. Tesla stock obviously is taking it on the chin. It's up about 2% today, but year to date it's off about 32%. So it's real some concern out there about demand. So let's get right to it. Steve Mann. He's our global autos research analyst for Bloomberg Intelligence. He's based out of Princeton, New Jersey, joining us via Zoom here. So, Steve, talk to us about this news from Tesla trimming its output in China. What's driving that?
Yeah, Paul. I mean, the stock's down about 1.5%, like you said. I think the consensus have pretty much factored in the potential cuts in production given the demand. I think demand, in China, it is slowing down. There's a lot of price cutting, not just from Tesla, but from BYD and Geely. It's a never-ending price cutting cycle over there. In the U.S., we're actually forecasting to be up 9%, definitely single digit, down from double-digit growth in the past couple of years. So, I think the production cuts are probably mainly driven by the U.S. and the China market, European to a lesser extent.
Steve, as you mentioned, BYD, the big competitor to Tesla in China. You always hear how fierce that competition is, but I wonder how the vehicles stack up. Is BYD actually making a car that is as high performance, as has all the bells and whistles of a Tesla, or are they a little bit behind?
I think BYD and other local Chinese automakers, because they're so focused in the Chinese market. I mean, now they're starting to get, kind of extend beyond the China market. They're pretty nimble in addressing some of the needs from the consumer side, especially on the connectivity and all the infotainment system that they have. So they are pretty much catered to the Chinese market. They're doing a pretty good job on that. In terms of quality, they've come up to the curve quite a bit. I think I remember visiting the BYD plant probably around 8-9 years ago. I still see like hammers, people using hammers to punch fenders together. But now they've moved well beyond that. I think not really nationalism, but with their cheaper cars, with lower cost of production, the Chinese have been very competitive and been taking market share from foreign brands.
All right, so just, Steve, what's your view kind of over the overall demand for electric vehicles globally? The concern is, I think for a lot of investors, that it is materially slowing down. A, do you agree with that? And B, why do you think that is?
It's about affordability. If you look at a lot of the vehicles out there in the U.S. and Europe, EVs out there, they're really expensive. They're above $50,000. There are a few that are below 50. There's not that many that are below 30. So it's really an affordability issue. A lot of the people that can afford EV have, and would like an EV have purchased one. But what's really exciting, I think, in the next couple of years, and I think we'll see a potential cyclical improvement in EVs, is actually in 2025 and 2026, when there's a whole bunch of kind of sub 30,000 EVs come to the marketplace, especially in the US and Europe.
Steve, some days anyone who is on the X social platform might actually forget that Elon Musk is the head of Tesla. He's so focused and active on X in these sort of culture war issues. Is there any sign of that in the numbers yet as far as affecting demand? Is his are his political stances moving the needle at all, turning any potential customers off, do you think?
I mean, I think people who buy EVs and are looking to buy a car, I think they are disconnected for some of the rhetoric that comes out from Elon Musk. Their performance in terms of sales is actually no different than what everybody else is seeing. So I really don't think there's a huge impact on sales, based on what he writes on X or what he says on interviews. Not at all.
Talk to us about the profitability of the EV car manufacturing right now. If prices are being cut, the unit profitability, what's going on there? Because they had achieved, I believe, some time ago, positive unit profitability.
They have, and they still are. And look, the one of the issues that was facing the industry in the past 18 months is price cutting. And I'm hoping that we're at the tail end of it, because Tesla actually has announced price increases in China starting April 1st. It's about a 5 to 8% increase if you also strip out some of the other incentives that are out there. And they're also planning those price increases in Europe and as well as the U.S. And I think part of that is because the material costs for batteries actually have ticked up a little bit. So, the material cost for battery increasing could be a catalyst for an end to this seems like a never-ending price cutting.
How's the Cybertruck doing, Steve? Is it meeting expectations?
Cybertrucks, I think it is meeting expectation. They're still ramping that up. Sales have been they're trying to fill the million unit back order. And according to what we're hearing in the marketplace, the used vehicles, used vehicles meaning a few weeks, few months old, they're actually selling at 2 times the amount that they're selling at with the new vehicles.
Wow, really?
So, yeah. So I think there is demand for it, but again, it's not going to be at the same volume as the Model 3 and the Model Y, where they're selling over 1 million units, close to 2 million units. This is still going to be relegated to a niche market, to a smaller group of consumers.
All right, good stuff. Steve Mann, thank you so much for joining us. Always appreciate getting your thoughts. Steve Mann, Global Autos Analyst for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, so we've had, I'm going to call it a really, really good week for the IPO market. A-Lab, which is a great ticker. I love that, ALAB for Astra. That stock's up again. IPO'd, started trading Wednesday. Reddit started trading yesterday. It was up a gajillion percent. It's down 9% today, giving a little bit back. No big deal there. But I'm going to get into the story here because it seemed like very well received Reddit by the market yesterday, the IPO market. Mandeep Singh joins us here. He pitched me hard yesterday to go in size on this IPO. So I put a 10% order in. I'm not sure if I got anything, but with the underwriters. But Mandeep Singh joins us back here in our Bloomberg Interactive Broker studio. So I guess Reddit is a social media platform. You get a big audience, you sell advertising. We've seen that game before. Big cap ones are the Facebooks, the Googles, the smaller caps are the Snaps and all that kind of stuff. This fits into the smaller cap thing. Why can't they make money on that business?
Well, one, if you compare the user base, it's still of the size of, Snap and Pinterest. But remember, Snap and Pinterest are 3 to 4 times bigger in terms of revenue. So this platform is vastly undermonetized.
Why is that, do you think?
Well, they never had an ad platform to begin with, and they started developing ad tech solutions over the last 5 years.
Oh, okay.
The most exciting thing at the roadshow was really the data licensing business. That's what at least everyone thinks has a lot of potential. They're not going to take digital ad share from Meta or from Google. It's more about what can they do in this unique data licensing business, which if you believe in the Gen AI story, then I think there will be a time when investors will start looking beyond the picks and shovels semi plays, and that's where companies that have unique user generated data, they will get a lot of attention, and we think Reddit is uniquely positioned. So it's sort of refreshing to see an IPO that goes beyond the semi plays and the hyperscaler, the Mag 7 that is getting all the attention, and I think that's part of the reason why you're seeing the IPO do so well.
Well, Mandeep, I wanted to ask you about that. I mean, I guess the notion is that a generative AI company will license access to all the posts on Reddit to help AI sort of learn to speak like a human. Although I got to say, from some of the posts I've read on Reddit, I don't know how good of an idea that is with the Wall Street Bets type of post. But how big of a potential sort of source of revenue for that is that for Reddit? I mean, there's a lot of hype around AI. I'm wondering if you can help us sort of really cut through that and figure out how big of a business could that be for Reddit?
Yeah, so the Google license, we know it's about $65 million per year. So if you think at least there would be 8 or 10 large language model companies that will license the data, that adds to 600 million.
It's not exclusive at all to
at least we haven't read anything to suggest it's exclusive. So that just goes to show that there is a lot of potential in data licensing. And remember, this is like a 95% gross margin business. They don't have to spend any money in terms of rolling that out as a product. So that's one. And to your earlier point about, the quality of the posts and the data that's used for training, I think one of the things with large language models is not only do you need good quality data, you actually need bad data to put the guardrails. So it's something that every LLM company is doing, is iterating to their models, making sure they're putting the right guardrails. And with Reddit, the unique advantage is this is human curated data. This is actual user data, not generated by machines. And obviously with the 1 billion posts they get every year, this keeps, getting updated. So as an LLM company, you want to make sure you have the most up-to-date user-generated data to be able to design the chatbot functionality on top of it. Whether it's good data or bad data, you actually need both, I would argue, because that's how you put the guardrails in. And remember, Reddit is only text, so they don't play in the images or videos. That's more for, the YouTube and the TikToks of the world. So this is a text-focused LLM play, and I think that's where they are uniquely positioned.
And just on that other IPO, again, Astera Labs, ALAB, up about 9% today, third day in a row that it's been higher. So that continues to be a really good story. So 2 good IPO stories this week. Hopefully that can get some of these equity capital market bankers off their fannies and get out there and do some more deals. I mean, that's what I'm thinking. All right, let's switch gears. Apple. I guess the question for a lot of people is, how significant is this latest round of regulatory scrutiny, various suits by various regulators around the world? How material is this to the short, intermediate, long-term investment story for Apple? Is this a 1990s Microsoft overhang, which was not good for the stock, or is it something that the stock can power through?
I mean, judging by the stock reaction, it did, suggest that this doesn't bode very well for Apple in the near term, given all the attention they're getting, both in the EU and now in the US. And I think one of the things that happens when you come into this kind of scrutiny is you can't make any product changes. You can't do even tuck-in deals. I mean, I can't imagine Apple or Google buying any company. Microsoft sort of is circumventing that by breaking a company apart and, poaching all the employees as they did with Inflection. But it just goes to show that once you are in the crosshairs like this, it's very hard to roll out a new product without getting more attention. And in this case, the monopoly argument is really geared towards their app store. So we all know that Epic Systems trial has been going on for 3 years almost. And even though Apple have one verdict in their favor, it looks more and more that Apple has to make changes to open up the platform, whether it's third-party billing or other type of changes. And to me, that doesn't bode very well for the services line. Ultimately, that is the high margin business. And if they have to lower their take rates or open up the platform to third-party billings, that's going to hurt their high margin services revenue.
What do you think a resolution would look like? I mean, could we imagine them actually spinning off the App Store as a separate business?
Very unlikely. I mean, it's so hard to decouple App Store from how Apple's operating system is set up and how, all the devices can interoperate, whether it's your iPhone, your iPad, or MacBook. So I can't imagine them decoupling their App Store. At the same time, what they have to do to convince the regulators is basically a level playing field when it comes to third-party app stores. So right now, there are a number of companies that sign up outside their apps, like namely Netflix, Spotify, because Apple takes a 30% cut for every subscription that goes through their app store. So that's where, they have to show to the regulators that even if companies want to deploy their own app store with their own billing systems, Apple is open to that, and you can move out of the Apple ecosystem to go to Android or any other operating system. So all these changes are what I think will happen over time.
Mandeep Singh, great stuff as always. He never mails it in. He's in our Bloomberg Interactive Broker Studios. He's a senior technology analyst for Bloomberg Intelligence. Appreciate getting some of his thoughts here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, there you have it. Crossing the Bloomberg terminal. House passes bill to fully fund the government, and they're sending it on to the Senate. To get more on this, we're joined by Jeanne Sheehan Zaino, professor, a Bloomberg Politics Contributor, and author of American Democracy in Crisis. Jeanne, thanks so much for joining us here. I think, do we have her yet, or are we still kind of working on it? Okay, we got her. Awesome. So what do we make of this? I mean, thank goodness they passed this here, but anything unusual going on here in D.C., or is this kind of more of the same? Let's get it done at the last minute.
It is more of the same, although I have to say this is highly unusual. We are, 6 months late on this bill. But since this is a positive day, I'm going to try to be positive. They did pass the $1.2 trillion government funding bill, and they now are moving it to the Senate. And, of course, only half of the crisis is averted so far because, of course, the Senate is, they're expected to take it up pretty quickly. But as the Senate works, any one senator can slow this thing down. And we know there are about a dozen amendments on the table. So, on the plus side, the senators all want to leave town so they can get their 2-week recess. So that may help them push it to the finish line quicker. But, we still aren't over the hump yet, but we are on our way, so to speak.
Jeanne, one of the new pieces of news that's emerged over the last few minutes is Punchbowl is reporting that Representative Marjorie Taylor Greene has filed a motion to vacate the speakership. Does that have any risk to this bill? I mean, I would guess not since it's passed, but how does that fit into all of this?
Yeah, I mean, we always expected this would happen, and this has been the way that the conservatives in the House have operated. What's quite startling about this is that this bill is probably more, a little bit more liberal or progressive or pro-democratic, if you will, pro-White House, than the bill which caused them to get rid of Kevin McCarthy. And so, it is not a surprise that one or more member of the House Freedom Caucus, in this case, Marjorie Taylor Greene, has filed. But, at this point, it won't impact this particular bill. And Mike Johnson always knew that this was going to be the result of him working across the aisle and, of course, waiving the 72-hour rule. There was a lot that happened in the last few days that conservatives and Republicans who are, not Freedom Caucus members didn't want. But, to avert a government shutdown, this is what they had to do. Okay,
so for us amateurs who don't really know how this plays out, is this, from Marjorie Taylor Greene, is this something that Mr. Johnson needs to be concerned about or no?
I don't think so at this point, if only because who would they replace him with? So, nobody wants to be Speaker of the House at this point. So, yes, it's one of those jobs nobody wants. So, yes, he has to be concerned that, a member is doing this, but not surprised. But the reality here is this rule needs to change. This rule that one disgruntled member, whether it's Matt Gaetz in the case of Kevin McCarthy or Marjorie Taylor Greene now or anybody else in the future, can hold up the entire House caucus in terms of the Republican caucus and, quite frankly, in some cases, the government. So I don't think there's much of an appetite for this at this point. We are, so close in the midst of an election period. All these House members have to be back in their districts and they have to be running for re-election. So I don't think there's an appetite, but I think next term they really do need to change this rule that one member can do this, because it has really made this caucus ungovernable at this point.
And you mentioned that this is more of a progressive-leaning bill than what cost Kevin McCarthy the speakership. What did the Republicans give up a lot of priorities in this bill?
They did. A lot of that was procedural. For instance, having an omnibus, or in this case, a minibus bill at all, was something they didn't want. Waiving the 72 hours to review the bill, something they didn't want. Allowing people to put all of these amendments in, they didn't want, and we have seen that. So there's a lot here. Of course, just looking at one example, on something as important as immigration and homeland security, they wanted H.R. 2. They didn't get it. This bill, has emboldened to a certain extent our ability, so for Border Patrol agents and others at the border, but it doesn't go nearly as far in terms of securing the border as the Republicans wanted. So they did give some up, but of course, negotiation is what you got to do if you're in a bipartisan Washington.
All right, Jeanne, thank you so much for joining us. Jeanne Sheehan Zaino, professor, Bloomberg Politics Contributor, and author of American Democracy in Crisis.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.